Not all of them? All right, well, we're going to go over some of that tonight. But the things that I want to tell you, there are some things in the tax code that is going to trip you up and may really increase your tax. So I will go over some of the really important things. Now, there is a litany of changes. I will not be covering 100% of it, but these are just some areas I really want to pinpoint, because if you're not aware of this is generally going to cause you more tax. So one of the changes that they had in the tax code was that we no longer get an exemption for ourselves and our children. And what that means is that we normally would write ourselves off and get an exemption amount. So last year, the exemption amount was $4,050. So for a family of, say, 4, that was about $16,200 that you were to receive as a tax deduction. This year, there are no more exemptions. So you don't get to write yourself off anymore on your taxes. So it doesn't matter that I have how many children you have, how many kids you have, you no longer get exemptions for them. But we want to be very careful, and we still want to claim our dependents on our tax return, because number one, we want to claim our dependents for medical purposes. If you are carrying them for medical insurance, if you have dependents on your return where there's college credits, you want to make sure you claim your dependents for that. There's the child tax credit that is still available to you. So you want to definitely take advantage of the child tax credit, and that credit has increased to $2,000. The child tax credit increased for kids 17 and below, okay? We also have the dependent credit, not dependent care, but the dependent credit. So now if you have like an elderly parent on your return, a significant other, a brother or sister, somebody else that you're caring for, you now get a $500 tax credit for them. And I want to distinguish between a tax credit and a tax deduction. A tax deduction means if you were to make $1,000, for example, and you had a tax deduction, you would minus of, let's say, $100. You would minus that $100 from $1,000 and be taxed on $900. That's a tax deduction. A tax credit is actual tax. So for example, once we calculate your tax liability, and let's say you owe the government $200 and you got a $50 credit, that credit would subtract and deduct from the $200 and drop your tax bill down. So that's the difference between a credit and a deduction. So credits are important if you qualify for them. So that's one thing that I want you guys to look out for. The second item that I want you guys to look out for has to do with the 20% business income deduction. So we've been hearing that the government is going to give businesses, LLCs, sole proprietors, S corps, partnerships, a 20% flow through deduction. So when I hear that, I would think if I made $100 grand, that I'm gonna get a $20,000 tax deduction, right? Wrong. That is not how that is going to go. That calculation is so convoluted that I have a book about this thick trying to understand it. It doesn't work exactly like that. So what's real important about that is it's not going to be a flat 20% at all. There is a really complicated calculation that goes along with that deduction. It's just not going to be 20% of the income. So I don't want you guys to think that. And the other thing is, if you have an entity, if you have a flow-through entity like an S corporation, you really do need to have payroll in order to fully take advantage of this 20% deduction. It's very, very complicated. So one thing that I'm going to say to you is, and I'm going to cover this further, is that you absolutely have to make sure that your books and records are accurate. You really have to make sure that your books and records are accurate. So just know that that calculation is going to be necessary The forms we have preliminary forms. The forms right now for the calculation are 5 pages for the 20% calculation. So it will be interesting to see how that gets pared down or expanded. But that's where it is right now. You guys follow me? All right, so the next thing is SALT, the state and local tax. This is really important for us people here in California, our clients, New York, New Jersey. SALT stands for your state and local tax. So there is now a cap of $10,000 on your state and local tax deduction. Your state and local tax deduction includes your DMV fees, your state income tax withheld, and your property taxes. That's considered your SALT deduction. Are you guys following me so far? Okay, so there's a cap of $10,000. Now, we want to be very careful with this because if you have to choose between deducting your state income tax versus your property tax, you want to deduct your property tax first, not just default to the state income tax. That's really important. Does anybody know why that's important? Let me tell you why. Because state income tax can become taxable the following year, right? You guys get those 1099-G forms if you got a state refund. The state refund that you get because you deducted state income tax becomes taxable the next year. Property taxes do not drive taxable income. So if I have a client who has property taxes that are around $9,000 and maybe their state income tax deduction is $5,000, I'm gonna take the full $9,000 property tax deduction first, then $1,000 of the state tax. So then the next year, the only portion of that state tax refund that could potentially be taxable would only be the $1,000. It gets a little complicated. I just want your awareness to be on it. It's very important that your awareness is there. Don't just give your information to your tax person. If I'm not your tax person, if you're giving your information to somebody, you need to check for that. Because that's going to drive taxable income that you don't need to have. That's very, very important. It could create taxable income for you. Are you guys with me on that? Okay. It's a lot of stuff. You guys got to keep up with me tonight. All right, so you want to make certain that you deduct the property taxes first, and again, your state income tax becomes deductible. Meals and entertainment deduction. How many of you in here have a business? Okay, a lot of you have a business. Are you guys understanding the meals and entertainment deduction now? I didn't hear you. Did you say something?
It said meals and entertainment.
And meals and entertainment. Are you guys aware of the changes there?
Changes?
Yeah, there are changes. So entertainment is no longer deductible. Entertainment, right? Meals are still deductible, but if you put meals together with entertainment, it's not going to be deductible. So I have a question for all of you business people. When you guys are entertaining, are you entertaining or are you marketing?
Marketing.
I want to see how many people are marketing.
Marketing.
Right?
Yes.
If I'm going to entertain you, we go into Disneyland. I don't entertain people. We market to people, right? So just remember that. As you are classifying your deductions, don't have deductions in entertainment because entertainment is going to get disallowed. Who determines whether it's entertainment or whether it's marketing? Who makes that determination?
I did.
Who?
I did.
Who said I do? And who said the IRS? You said the IRS? No, we determine what our deductions are. We decide. And I want you guys to know that that's very, very important. You decide what your deductions are. And then we tell the IRS why we have those deductions. If we let IRS to decide, they're all going to be entertainment, right? You tell the IRS, I'm not playing around. This is strictly business. Like, this is what we do. So just remember that. Get rid of the entertainment part. So meals, there's no more entertainment. Meals can still be deductible. Client meals and traveling meals. Traveling means you're going more than 50 miles away from your primary place of business and you eat outside of that 50 miles, that's considered a traveling meal. So you can still deduct those. So just remember, no more entertainment. There's no reason to entertain people. That's gone away. So we definitely want to watch out for that trap in terms of that. So if you have your profit and losses, get that cleaned up on your profit and loss. Don't even turn that in at all. Now, something that is extremely, extremely important is IRS put out a bulletin that none of you probably got, right? It just cracks me up that IRS put this bulletin out. Who did they put it out to and where did they put it out? Because you guys didn't get the bulletin. Well, the General Accounting Office, which is the government's accounting office, the GOA, put out a bulletin and said that taxpayers, based on this new law, are going to owe. They told IRS that. IRS posts a bulletin on their website to taxpayers, and if you guys go look, you'll see it. It says, "Dear taxpayer, because of this new tax law, we think you're going to owe. So we want you to do a W-4 calculator or a tax estimate, and if you're going to owe, we want you to pay us right now." That's what's out there on their website. So they issued that bulletin. So because of that, I took it a step further. I said, let me do a little research. Let me see what's really going on behind the scenes. So because the government knows that they're going to be short on funding, they are going to put more effort towards their collections department. Because IRS has a collections department. Why does IRS have a collections department? Does anybody know?
Collect money.
So they can collect money. IRS is the collector for the government, right? You do realize that. IRS is the collection bureau for the government, all right? So they are now going to put more resources toward their collections department. And when they put more resources towards their collections department, that means there's going to be more audits. Do you think that they're going to audit the basic W-2 wage earner? No. Why is that? Because their tax return is a W-2 and it's real simple. They're going to audit the business people, the people that get the 20% flow-through deduction, the LLCs, the limited liability companies, the partnerships, the S-corps. Those are the people that are going to be more exposed to audits. So it's going to come. It is happening. I subscribe to a lot of online groups of other tax professionals, and that is definitely the chatter. It's in all of our publications to tell your clients to brace themselves because the audits are going to come. Does that mean that we don't take our tax deductions? Is that what that means?
No.
What does that mean?
Trying to get more deductions.
Get smarter about them.
Get more deductions? What did you say over here?
Get smarter about them.
Get smarter about your deductions?
Keep your records.
Keep your documentation. And also, it's sort of like this. When you watch a basketball game, because now we have, who do we have in LA now? LeBron?
Yeah, we got LeBron.
We got LeBron now in LA. So when LeBron came to LA from Miami, where'd he come from?
Cleveland.
Cleveland. All right, I'm not a basketball person, okay? Work with me. When LeBron came from Cleveland, he didn't come from Cleveland with his Cleveland jersey, right? When he came to LA, he put on a Lakers jersey. So when we file our tax returns, we got to make sure that our tax returns look very neutral. We need to look like a part of the team. We don't want to stand out. So we want to make certain that when our tax returns are being filed, that they're being filed correctly, that there's nothing extra special going on our tax return that's going to give IRS a reason to flag our return for an audit. We want to make sure that things are correct on our tax return. Let's just blend into the crowd. This is not where we want to be unique. We want to be special, not when we're dealing with the IRS. So we want our tax returns to go in very vanilla. And what does that look like? That means that our categories are accurate. That means our tax returns are filed correctly. All the forms are there. The calculations are correct. I cannot tell you guys how many clients come to me because their tax returns have gotten audited. And when I look at that return, I know why that return was audited. I see why it was audited. So we want to make sure that things are done correctly. That's very, very important. All the way down to the name being on the tax return correctly. And those are important things to prevent your return from being audited. So again, there's going to be more audits, and IRS has already put out that bulletin that you guys need to pay them what you owe them immediately. So just FYI, the last date technically to make your payment for 2018 if you owe, the last date technically is January 15th. It's not April 15th, it's January 15th. Just so you're aware of that. So if you owe IRS and you make that payment on January 15th, you blend it in with the crowd. If you owe IRS and you make the payment on April 15th, you're sticking out like a thumb. Okay? And you guys know why I say January 15th? Because IRS has us on what we call a pay-as-you-go system. The pay-as-you-go system says that we are supposed to pay our taxes as we go. When you are a W-2 employee, the taxes come out of your paycheck. But when you are self-employed, own a business, you're supposed to make quarterly estimated tax payments. Quarterly estimated tax payments. April 15th, June 15th, September 15th, and then January 15th of the following year. That's where I'm pulling those dates from. So if you want to blend in with the crowd, we want to project what our taxes look like, and if we truly are going to owe them, we should really cut that check by January 15th and just be done with it. That's where I'm getting those numbers from. A lot of people think that April 15th is that deadline date, but it's not. It's technically January 15th. Okay? You guys with me? Yes.
Question, but the estimated taxes, we already know what those are going to pay those. My business is growing, so I know that I'm going to have additional.
Yep.
I actually made an extra payment, but I had no idea what my actual tax burden is.
Yeah, so what you should do in a situation like that, and thank you for that point, most of us business owners, our businesses are escalating. We are paying based on last year. So you made your estimated tax payment based on your 2017 income, which could mean you overpaid or you underpaid. In your case, you think you're underpaid because you know your income has gone up. That's where tax planning comes into play, because we want you to be smart on. I don't want you worrying about how much you're going to owe, nor do I want you overpaying and wait on a refund either. So we should really be pretty smart on, be within about $500 by now. So that's something we probably need to talk about a little bit. And if you owe, you may end up being penalty proof because you covered your estimates, but at the end of the day, I don't want to have to cut a big check. Like, I really want to plan my money out and really be strategic with that, right? So April 15th, you write a check for 2018, and then you write another check for your first estimated payment for 2019.
Every year.
Every year, so that's not fun. So we're going to get that sorted out. Okay, so you guys understand that part so far? So there's a lot of changes. I just want to make you guys aware, and the time really to look at it is now to get it sorted. There's also changes in the 1031 category for those of you that are selling rental property and doing 1031 exchanges, or you're selling other assets. It could be a business, it could be stock, it could be other assets, and doing 1031 exchanges. This has changed as well. So under the new laws in terms of the 1031 exchange, there's a repeal of any personal property. Any personal property. So this is going to go into, if you own some type of business and you're trying to do a 1031 exchange, and maybe you have some goodwill involved, maybe there's some amortization of a trademark, or maybe there's some personal property that's not real property attached to the building. That can no longer be 1031 exchanged. Okay? So, for example, let's say if I'm selling an apartment building, if I have washers and dryers and stoves and refrigerators, that's considered personal property. That's not real property. Okay? Real property being an actual building or actual land. So we want to make certain that if you're going to exchange properties, that we make sure we get that calculation correct and that we plan accordingly. That's really important because you can wind up having a 1031 transaction that ends up being taxable. You guys follow? So that's really important. Are there strategies to combat that? Absolutely. But the calculation needs to be done before we get into the escrow. At least we need to know what we need to cover before that happens. We just need to plan around it. Yes.
So does that mean when a cost segregation is done, singling out personal property, all that stuff that was deferred supposedly, or not?
Well, not
It's taxable?
in that case, only because if you had a cost segregation study done, you get an exemption.
Oh.
So there's so many little changes. You're in a good position in terms of what you have going, because I can visualize your return in my head. You're good. But if you have a cost segregation study, IRS has carved out some additional rules that allow you to kind of get away with things. Do you guys know what a cost segregation study is? I'm going to tell you. If you don't, I'm going to tell you whether you do. Let me tell you what that is. So if you own rental property, and I've mentioned this before, and I can't hammer this enough, if you own rental property, the fastest way to lower your tax bill is to do a cost segregation study. A cost segregation study, very simply, is this. When you depreciate residential rental property, you're writing that cost off over 27 and a half years. If we do a cost segregation study, we can take that cost, and right now we can take about 100% of it in the current year under the new law if we have a cost segregation study. So it is a great tool for dropping your taxes immediately. People get concerned about, what about the depreciation recapture on the back end? Well, when we get to the back end, we'll come up with another strategy. But it's always better to drop your taxes today and let tomorrow take care of itself, because there will be new strategies and new laws out there. So if you have rental property, you need to look at doing a cost segregation study, especially now that we have this new tax law on the horizon. You guys with me? All right. So just know that there's a change in 1031 under the new laws. Okay. Why under the new tax law accounting records must be accurate? This is so important. A lot of clients will come to me with handwritten accounting records. You guys do a really good job of making notes really well, and you guys know exactly what's going on with your financials. But now, because we have this new 20% deduction, IRS requires that businesses have a balance sheet. A balance sheet. Most of you are going to have your income and all of your expenses. So whatever you make, whether it's rents, all the expenses, mortgage, repairs, whatever the case may be. But the 20% flow-through calculation requires us to have a balance sheet that shows all of your assets. So if you have rental property, we need to make certain that we have all of the cost of your buildings allocated properly, and anything else that you have, because we want that calculation to be as high as possible. So if you guys have desks and chairs and home office equipment that you guys are utilizing, we now want all of that to be reflected on the balance sheet of your business. If you have a business that is not a rental business, you really want to have a balance sheet. In the years past, you didn't need to have one if your income was below a certain amount. But now you want to have it regardless of the level of your income. You need to have that. So what does that mean? What is a balance sheet? A balance sheet is where we correctly reflect the assets, bank accounts, property, personal property, equipment, cars, vehicles, and we correctly reflect the liabilities, what you may owe out. That's a balance sheet similar to a net worth statement for individuals. That's going to be important for us to get that calculation correct for you, to make sure that you guys get the biggest 20% flow-through deduction that you can. So the top is 20%, but it's going to start decreasing based on other calculations. So we want to keep it as high as possible. So the key for you is you need to automate your accounting records. If you guys are still doing these ledgers and these spreadsheets and write on the back of a piece of paper and doing all these other things that you guys are doing and using your, what's that little old machine they used to have back in the day before I was born? What was that called? The slider?
Slide rule.
Slide rule. I don't know anything about that, but I saw pictures of that, right? If you guys are still doing that type of stuff, it is time for us to move into the 22nd century, seriously. We gotta get our accounting records up on an accounting program because IRS requires adequate books and records. That's the definition. What's adequate books and records? Adequate books and records are books and records that IRS can understand very easily. If you don't have records that IRS can understand very easily, then they're gonna start asking you for your bank statements, your credit card statements, and then you're just gonna open up a can of worms. So my suggestion is to get your accounting records on an accounting program. At the very least, you guys should be using QuickBooks, Hurdler, something. But you've got to get your accounting program into the 22nd century, right? How many of you guys have smartphones? Everybody in here has a cell phone? If you guys have a cell phone, you have an accounting program in your hand. So we want to start to use it. If you guys need help with that, I definitely can help you out, but you want to make sure you do that. If you paid yourself through your business, whether it was draws, whether it was distributions, whether it was a paycheck, we want that clearly identified. Clearly identified. It is going to matter when we do your taxes. All right? Okay, let's keep moving. All right, now, let's talk about the federal laws the states are not following. What does that mean? That means that the government came in with H.R. 1, that was the name of the bill that passed, and they changed all of these tax laws. Tons of them, almost everything in the code changed. But guess what? All the 50 states said, we're not changing the law. Uh-oh, what does that mean? That means that, remember I told you you can no longer write your kids off on your taxes? Well, you can on the state. So that's a difference. Remember I told you that there is a limitation on your SALT deduction, your state and local income tax deduction? Well, there's not a limit on the state side of the equation. So you gotta still keep up with all of those records. There is going to be an expansion, of the form, the California form, that shows all the differences between federal and state. That form right now is 2.5 pages because the states have not conformed to the federal laws. The states have not conformed to the federal laws. Does that mean that they won't conform? They might later on down the road, but not yet. So that brings up a whole lot of issues that I could kind of think about in terms of what things really need to look like on our tax returns. You know, on the one side, I don't want to deduct my state income tax on the federal, but I do want to deduct it on the state, so there's a lot of moving parts there that we have to look out for. Also, those of you that moving expenses are not deductible on the federal, but moving expenses are deductible on the state. As of December 31st, or one day after December 31st, 1/1/19, alimony is no longer deductible to the federal for those people newly divorced, but it is on the state. So that's a whole thing that we need to look at. There's just a lot of changes. And there's actually a list of about 40 things that I can actually, if you guys want it, I can have it emailed to you of just the differences between federal and state. Where federal is no longer taking the casualty losses. You can't go back 15 years on the federal anymore if you have a big loss, operating loss. You can on the state. So there's a lot of differences between federal and state taxes this year. So what does that mean? That means that our planning is really critical because we got to make strategic decisions based on what the recapture is going to look like on the state side versus the federal side. It used to be we could just make our decision based on the federal, but now we got to fully analyze the state side of the equation and determine the best way to handle things between federal and state. So there's going to be a lot of differences there. The key takeaway here is make sure that you still continue to keep track of 100% of your stuff, right? Make sure you keep track of 100% of it. I am anticipating that we're going to file tax returns and that we're going to get probably some repeals of some of these laws retroactive. And then you're probably going to have the option to amend or not amend, just because they're so complicated. And some of them are not formulated correctly. Like when you do the calculations, it's really, I don't think it was what they anticipated. But if you guys remember, when this tax law was happening, they were up to 12 midnight trying to pass the law real fast, right? And it just cracks me up. I want to know who on that Ways and Means Committee is a tax person. It's just really interesting to me to see that they passed this tax law like this, and the calculations are incredible. So there's going to be a lot that we need to contend with in regards to that. All right, so let's keep moving here. So what you need to do now to minimize your taxes under the new tax law, and you guys really need to write this down. This is what you truly need to do right now. If you haven't done this has to happen. The number one thing that I am going to tell you to do is strategically plan. You need to know where you stand with your tax bill, literally. And you want to find out before January 15th. Why do we want to find out before January 15th?
Because you owe money.
Because if you owe money, we want to get that money paid into them if we plan to pay them, right? We want to get that money into them. We got to get ourselves organized. Why do we need to get organized? Anybody? Aside from being nice to your accountant, that's the number one reason you want to be organized. That's the first thing, because your accountant loves you to be organized. But the other reason why you want to be organized is because you don't want to miss out on your deductions. If you're not organized, you're going to miss out on your tax deductions. Tax season is going to get crammed down into a few weeks. And if you're not organized, you're not going to have an opportunity to get the tax deductions that you normally would get. So the organized individual is able to deduct more on their taxes. The other thing that you need to do now is get your accounting records in order. And I am going to suggest, just as a goal for 2019, that you even get your personal records in an accounting program. All of your personal expenditures, roll it through an accounting program. I did that one year, and I almost fell out of my chair when I saw how much money I spent eating out. It was crazy. I stopped doing that year. I'm like, I can't keep track of this anymore, it's too stressful. But no, seriously, we need to keep track of our personal dollars. When we track our personal dollars, we save more money, we really do. It's unbelievable. Like when ATM cards came out, it just seemed like we had magic money, right? Some of you guys were around before these ATM cards came out. I wasn't, but my parents told me about it. So when these ATM cards came out, it just seemed like there's magic money, right? When we used to pull money out of our pocket and pay for stuff, we were a little bit more stingy with giving away our dollars, right? We're like, give me back that money. But now with the magic money, with the ATM card, and let me tell you something, Bank of America is really slick. I have my kids' accounts. I started accounts with them when they were little, and they'll use their ATM card, my 16-year-old, and he won't have money in his account, but Bank of America pulled money out of my account, put money in his account. So it's real magic money going on now, let me tell you. So now that we have this magic money going on, we don't pay as much attention. How many of you have balanced your checkbook? See? Okay, wait a minute. 1, 2. If you balance that checkbook, I want them hands up high. 1, 2, 3, 4. So about 5 or 6 of you have balanced your checkbook. And it seems to be our more seasoned, our more smart people in the room. Our seasoned, our smart people, yes.
So when you're talking about magic money,
Yes,
it disappears when they charge 19 to 24% interest.
that's exactly
The
right.
magic is in their hands, not
That's
ours.
exactly, the magic is in their hands. It's like, voila, we took your money. That's exactly what's happening. And
Forever.
then, I'm taking a step further. They take the money out of my account and then charge him an overdraft fee. I'm like, really? Did you take the money out of my account? So, it's just bananas. but we have allowed this to happen out of convenience, right? Because we've really kind of gotten a little bit lazy with this magic stuff that's going on. And then, if that's not enough, now we're doing that Zelly thing, right? Zelle. How many of you guys are familiar with Zelle or Venmo? That's even scarier. Mom, can I borrow some money? I'll Venmo you back. You're not going to Venmo me back. You're not going to get my money to begin with, right? So that's another stuff. We got to really, the real bottom line to this is, we got to start being a little bit more accountable. Have any of you guys heard about blockchain?
Yes.
Okay. Does anybody know what blockchain is?
No.
Okay. Blockchain is where literally our transactions that we're doing are out there and are already being recorded out there. So IRS is really going to have access to what we do on a daily basis anyway. It used to be IRS only got access to what was reported to them, right? Our W-2s, our 1098s, all of those documents. But now with blockchain, all the transactions that we make are out there and being reported. So I really do believe a few years from now, with all of this artificial intelligence and all this other stuff that's going on, that IRS is going to know how much our businesses have already made. They're going to have that information. It's sitting out there. It's just a matter of them creating some type of computer system to pull it in a fashion where they can read the data. That's scary. So if IRS is going to have access to my data, I need to get it in a format, and I need to be prepared to present it to them in the format that I want to present it to them in. That's really, really important. And I'm going to take it a step further because I'm a weirdo with stuff like this. How many of you guys have Alexa in your homes?
Yeah.
Okay, some of you guys have Alexa?
Yeah.
All right. So do you guys think that when we have Alexa or when we have Siri talking to us here, do you think they're recording what we say?
Yes. Yeah.
Right? The IRS is listening. I think Alexa and the IRS got a little partnership going on. They're listening to us. No, seriously. I really do believe that. And I'm not a conspiracy theory type of person, but I believe that if that intelligence is there, they're going to figure out a way to use it. It is there. So everything you can and say to Alexa will be used against you. That's for sure, right? All right. I want to open it up for questions. Does anybody have any particular questions they would like to ask me before I go further and cover a couple more things? Anything? Yes.
Are you saying that we're throwing money away because we're not planning and preparing our paperwork properly? Uncle Sam basically enjoys the fact that we're not sophisticated.
Yes, of course they do. Uncle Sam enjoys the fact that you're not sophisticated. If Uncle Sam did not enjoy the fact that we're not sophisticated, why aren't we taught about our taxes in school? We taught about everything else. Why do we not learn that? Most of us learn just to gather our paperwork and file our tax return, but nobody tells us to strategically plan. Nobody came to Karla Dennis and said, Karla, there's a tax code with over 80,000 pages pre-new tax law, right? There's probably 180,000 pages now. But there's a tax code out there that you can utilize. Nobody tells us that. What they told us was that file your taxes, get your W-2, go down the H&R Block so you can win, right? That's what we see on TV every single day. No one has said stop, strategically think, and plan to minimize your taxes. Yes?
Let's say that I call IRS and I want an answer on a question.
Yes.
And I get an answer. I say, oh boy, this is good. And I say, well, I'm not so sure that's right. And I call again, I get somebody else in IRS, and they give me a totally different answer.
Yep.
And so where am I with planning if I listen to them?
Don't. If you listen to them, you up a creek without a paddle. That's where you truly are. IRS is the government. You don't want to listen to the government when it comes to planning. You need a tax professional that knows how to plan. I know a lady, her name is Karla Dennis. She's an enrolled agent. Honestly, I used to work, for those of you who do not know my background, I used to work for a tax law firm that did tax planning for individuals and businesses. back when I first came out of college. That's why I understand tax law and how to plan. Most tax professionals get their license and they know how to do tax returns. That's different from tax planning. It's a completely different animal. In the tax world, there is tax preparation. You bring me your documents. I'll fill out your 1040, your Schedule A, your Schedule D, whatever that needs to look like. And we'll do that well. But there's also tax planning, just like you plan to purchase real estate, just like you plan to come here this evening. There's some thought, there's some strategy, there's scenarios, there's based on what your goals and objectives are today, tomorrow. There's planning that can be done to minimize your tax. Yes.
And so when it comes to tax planning, I lost the thought. But
you were talking about if you called IRS that they'll give you hang up and call back, they'll give you 2 different answers. So then you said, where would I be?
I got it. Relating to the example you gave about the gal that had the marriage,
Yep.
the wedding,
Yep.
and they had no idea that they had all of those deductions that
Yep.
were there. Well, how many of us are walking around not having a wedding, but other things like that, that all of a sudden, in talking with you, you can pull that information out, and we say, oh my God, I had no idea I could deduct that.
I would say the majority of you are walking around just like that. Honestly, I think we don't know what we don't know, right? So have you guys ever, taxes is not something that we like get up and enjoy, right? We don't get up, skip, and go, tax day, except for me. None of us really do that. So it's something that we kind of shy away from. It's like going to the dentist. You know you got a little bit of pain, but you really don't want to go to the dentist because they're going to numb you and your whole face going to be numb and you're going to be drooling and looking crazy for a minute and you're going to hear the noise of the drill, all of that going on, right? But when you walk out of that dental office, typically you're better off. And you can get, for some people, you can see that they can get their teeth fixed and they can get like a cap put in, or they can get really nice teeth done. It's available, but sometimes we just don't know. We don't have an awareness. So part of what we do, to answer your question a step further, we have a process that we take you through to pull that information out to see if there's options for you to strategize. And I will tell you that probably 97% of the people that we meet with, there are ways for you to reduce your tax bill. It's like you don't know about it because you're thinking about taxes from a W-2, a 1098, maybe rental property. You're thinking about the basic information, like going to a general practitioner, doctor, where they're gonna check your heart and your blood pressure, put you on the scale and all of that. But then when you go to the cardiologist or the other doctors, they drill down deep. That's tax planning. Yes?
So in the case where you have a call to IRS and you get this opinion and this opinion, and you come see you and we get a different opinion.
Yep, you're gonna get a different opinion if you come see me.
We're gonna be audited, or how do we stay away from being audited?
No, there's strategies to stay away from being audited. You're asking such good questions. I'm so glad you're here. There's strategies from staying away from being audited. So let me tell you something about the IRS. Number one, when you call Internal Revenue Service and they answer your question, they don't stand by those answers. Just so you know, that is not considered a valid answer for you. So if I write down, I spoke to Representative ID number 45638 on this day, they don't stand by that. That's not law. So if you call in the IRS to get an answer, that is not a good idea. That's for starters, because the IRS is a government agency, the collection agency for the government. Their job is to get money out of you. Now, you asked me another question, how do I know that you're not going to get audited? I don't know 100% that you're not going to get audited, but what I do know is I have a real good track record with IRS, and anybody that's an enrolled agent, you can look them up. You'll be able to figure that out, number one. Number two, I represent in audits for other CPAs who don't represent their clients in audits. I know what IRS is looking for. I've gone through the National Tax Practitioner training to sniff out what IRS is going to look for in an audit. And let's say you do get audited, right? Let's just say that happens. Uncle Sam does knock on your door. we're gonna make sure that whatever's on your tax return, we're not gonna do something that's not gonna be legal. It's gonna be backed up by the code. That's the true law, not even what an IRS agent says. I deal with IRS agents daily, and they'll tell me something, and I'll turn around and say, if you show me the law, we'll go with that. If not, I'll see you in court. That's how it works. So we wanna make sure we're working with law. And IRS is not law.
Didn't you say that the Congress people and senators, they passed law, didn't know what they're passing?
Yep, but it's still the law. Whether they knew what they were passing or not, it's still the law.
So you're saying we can take advantage of their mistakes?
It's the law. If the law says that we can go fast on a green light, we're gonna all go out here and go fast on a green light, because it's the law. So as long as we follow the law, we are doing what we're supposed to do. That's the key. We're always gonna follow what's in the code. We're never gonna step out of the code. We're gonna follow the law. The publications, the IRS website, the people you talk to at the IRS, that's not law. And I'm just pause, I got a couple other questions, I will come back to you. Yes.
I have a question. Will rental income be qualified for a business expense for the 20%?
Yes, it will, if you're set up properly and have a balance sheet set up properly. There are some steps you need to take, but yes, it's considered flow through. Did I have any other questions over here before I come back over here? Okay, go ahead.
So you think of the Encyclopedia Britannica.
Yep.
That's the IRS law, okay? It may be so big, so much, that it takes maybe 50 people to get together. Each one takes a little piece and they bite it. So how do you have knowledge from all of that?
I'm so glad you asked that question. Let me tell you how I have that knowledge. Number one, because I went to school and I got my master's in tax law. So when you get your master's in tax law, you have to go through every single code section in order to get your master's in tax law. So you learn every code section, and I can cite code sections like the back of my hand. That's first thing. But then as those code sections change, we are professionals. We stay updated with those code sections. And as you have experience in this industry, you get introduced to situations. You get introduced to situations. So do I know the majority of code sections like the back of my hand? Absolutely. But more importantly, and this is what's more important to you, is the fact that I know when there's an issue and I know how to research it to get you to the right answer. That's the key. Because the tax law, the code is absolute. It's absolute. We just need to find it. And to take it a step further, and this is really going to blow your mind, we can go to case law that actually trumps the code. It actually trumps the code, case law. So there are so many different things that you could do, but that's how we know. And then in my office, we have a brain trust of over 70 years worth of experience. Not just my brain. I don't have the biggest brain in the office. I know tax law well, but I have other professionals in my office that I can run things by. But we're gonna research it, we're gonna figure it out, and we're gonna get you the exact answer, and then we're gonna show it to you in black and white.
How many people do you have in your office, and how do I know that I get somebody as qualified as you?
Because I hire them. I don't hire weak people, and I don't say that lightly, I say that sincerely. Because when you come to my office, everybody wants to meet with Karla, right? That's just how it is. Everybody wants to sit with me. But everybody can't sit with me. So what I do every single morning, my team is in here, they'll tell you, every single morning we go to a meeting where I educate my team on the things that I need them to know. And then for them to be able to work with me, they have to have real experience. Like your tax returns are not the H&R Block tax returns. Your guys' tax returns are complex. They require knowledge in certain areas. So I'm pretty hardcore. I may look sweet, but I'm not. So when it comes to my team having knowledge, they have knowledge. My tax manager, who reviews off on all the tax returns in the office, he's pretty seasoned. I will put my brain against his brain any day. I would probably win, but he's a good guy, and he's sharp. So that's how you would know. Come check us out. Come talk to us. And there's people in this room that have done business with us. Any other questions? Yes?
When you say,
Hello.
when you say you go to case law, you mean precedent setting scenarios that you pull out like an attorney?
Yep.
Stop.
Yes, absolutely. That's exactly what I mean. Because people think that these publications that we get, those little booklets that we get, people think that that's law. That's nothing. IRS does not even go by that. That's the first thing. So as you start to climb the ladder and get more sophisticated, you're gonna go to code, and then you're gonna go to treasury regulations, and then you're gonna go to memos and regs and procedures, and then we're gonna jump to case law. That's exactly what we're gonna do. And I do that a lot. I have a case right now with a client who went to another high-powered tax person. They did a 1031 exchange. They sold 10 properties, 1031 into a big gigantic apartment building, except for they took title under the name of the LLC. And when you 1031, we know on a basic level, we dealing with clients with real estate, we know that that title has to be the same. You can't go from an individual and take ownership in the name of your LLC. Except that I know that there's a thing in the tax code called substance over form doctrine. And the substance over form doctrine states, hold on IRS, we need to look at the substance of the transaction versus the form. And there's about 10 cases that have dealt with this easily. So we pulled case law to prevent that client from getting hit with a $400,000 tax bill.
Are you saying that you were successful in getting that solution?
I am saying that I was successful in getting that solution, yes.
That's a biggie.
She was working on it on Christmas. She was.
I seriously, because I was determined.
She was.
I was determined. I had my laptop in my family's like, Mom, come in there. I'm like, okay, I'm coming. But I was determined because I just know that we're not the first ones, right? We're not the first ones that something has happened to. And so knowing tax law allows you to have that mindset to keep digging and keep looking. Yes.
Are you saying that you fight that hard for us?
Yeah. You deserve it, right? I'll fight for you.
I'm ready to sign up right now.
I'll fight for you.
I need a warrior.
We fight for our clients, of course. It starts out with doing the right thing from the very beginning. And it starts out with having that knowledge of what the right thing is. That's very important. So for our clients, when we're filing their tax returns, we're filing their tax returns with the right knowledge and the right support. And if IRS, for example, questions or challenges something, we're gonna fight for them. Now, I get a lot of clients who come to me that are in situations. I had a lady, and I'm gonna close it up with this because we're at our hour, and I promised we'd lock it up, so I'm gonna close it up with this. I had a client, this is one of my most successful cases. I love this case. This client came to me. She was a real estate agent. She was selling beachfront property, Huntington Beach, Dana Point, all of those nice areas, Newport. And she was doing really well when the market was hot, and she bought a yacht. A yacht, okay, not a boat, a yacht. So she took the yacht as a tax deduction. Does anybody know how much yachts cost? Who said that? Millions. Yachts cost millions. Her yacht was $1.2 million back then. IRS came in and audited her and disallowed her yacht. Can you imagine what her tax bill looked like? When they disallowed her yacht, not only for the year that she was audited, but they disallowed it for the year before and the year after.
The problem is, she wouldn't have the money to take and pay them. She'd
That's
be in
right.
real serious trouble.
She would be, exactly, she would be in real serious trouble. And so she had gone to one accountant who tried to help her, couldn't help her. She went to another accountant, couldn't help her. And then she came to me with an attitude. Because by the time they get to me, they typically have an attitude. But I don't take it personal. Bottom line is, we got that yacht deducted. Bottom line, she's now 1031 into a higher yacht, and we still got that as a tax deduction. I said that to say this. I am not gonna tell you I know 100% about everything, but what I do know is that at KDA, Karla Dennis Associates Inc., we know how to research, we will look it up, and we will give you guys the law. And that's what everybody deserves, is the actual law and the right opportunity to reduce your tax bill. I am going to close with, we always offer a 30-minute consultation. A conversation is definitely worth it to have a conversation to see where you guys are. I highly recommend that. I am Karla Dennis. It is always my pleasure to talk to anybody that wants to talk about tax. Thank you guys so much. I think you guys may have consultation cards. My team is in the back. They will take really good care of you, and I'm gonna make certain I fight for you. Thank you guys so much.
Could I ask one question?
Yes.
If I am not knowledgeable enough to bring you the kind of information that is properly
Yep.
rather than just take what I give to you and work with it, or can you look at it and see where I can be advised how I can improve
Absolutely.
on my
Situation.
situation?
Absolutely. So what we do, I don't expect you to know what to bring to me for me to make that type of determination. Part of my process that I take you through is going to extrapolate that information from you. It's in you. You don't know it yet. But it's my job to get that information to get you where you need to go. So you don't have to know. We have a process that covers that. Any other questions? Look like you guys want to hang out tonight. All right.
Who's got more questions? Just a question about Sapphire.
Yeah.
Saying that percentage you can make some dollar amount.
Oh man. So yeah, so that depends because there's changes in that area too. Lots of changes in the sub-IRA area. So it depends on whether we're going to take that 20% deduction or not, how much you're going to be able to deduct. It depends on if it's a traditional sub-IRA, if it's a 401k sub-IRA. So we're looking between 24,000 upwards of 40, depending on what your income looks like.
And if you take the, let's say 20% Sapphire, is it?
Hold it, but you right.
Yep. Yep. Yep.
Has any, has further more questions? Is the message?
Absolutely. All right. Are you guys?
When will this?
So if you guys have your consultation cards, Elizabeth, Zachary, they will collect those from you guys. And then they'll contact you to set up an appointment convenient for you.
Okay.
And we're doing that between now and like January 15th. We have wiggle room right now.
Okay.
Yeah.
Now, I have one other question.
Yes.
I am in the process of getting my business and law exam.
Okay.
But I passed my 3.
Okay.
Now, I came to you guys and you were advising me for filing my taxes under VG.
Okay.
So all that has gone through, but I haven't got my license until I pass my business certificate.
Okay.
Now, hopefully I will get through it. I'm sticking with it to really get through it. But in the meantime, my taxes are filed until 20 Would that raise a red flag as to as to filing, let's say, is it on the personal or VG, the company?
The way that I would handle that is I want to look at it and tell you the best case scenario. So one of the things I have is that I have a sophisticated program that I have compiled over time that when I run your taxes through it, it's going to tell me if there's any flags of IRS paper. So I have that, and that's just historical data that I have been able to track.
Okay, because, well, I dealt with Andrew and what's the other guy name? Alan.
Yeah.
So, Alan was like giving me that kind of guidance. But I think Andrew just taken my information.
Andrew is very, Andrew doesn't have the same type of personality as Alan, but Andrew is brilliant. He has a very brilliant mind.
Well, I admire him.
Yeah, his mind just goes real.
Why I know that? He works with his both hands.
Oh, yeah.
How can you do that?
He is Andrew's brilliant.
I know him.
Yeah, he is so brilliant. But absolutely, we'll look at that from that perspective. Absolutely.
And you know why we're here? Through my daughter.
Yes.
Remember I came with her first time. He retired, you know, from the DCI.
Yeah. Yeah. Thank you. Yeah.
And then she found out about this
Yeah. I'm glad. Thank you guys so much for coming out. I love doing this and educating and just really bringing awareness, to people. And whether they choose to work with me or not, at least